What is the effect of government policies on sugar markets? Imagine a world where the price of sugar is not just determined by supply and demand but heavily influenced by what governments decide. That's exactly what happens in sugar markets. Governments play a big role, especially in countries like the United States where sugar is a major agricultural commodity. These policies shape how much sugar is produced, how much is imported, and what prices consumers and industries pay. One way governments support their sugar farmers is through price support programs. They offer loans to sugar producers at lower interest rates, sometimes with no obligation to repay if they give up their sugar. This keeps prices stable and helps farmers stay profitable. Another common policy is imposing tariffs and quotas on imported sugar. These barriers make imported sugar more expensive, so domestic sugar stays competitive and prices stay higher than global market levels. Governments also set limits on how much sugar farmers can produce through marketing allotments. These limits prevent oversupply, which could push prices down. Sometimes, trade agreements are made to control imports, setting minimum prices and maximum quantities to balance trade and protect local producers. All these policies work together to keep domestic sugar prices much higher than the world market. For example, in the United States, sugar prices have been 20% to over 100% higher than global prices in recent years. This price gap benefits local farmers by ensuring they can make a profit and encourages them to grow more sugar. For investors, these policies mean that sugar prices are less affected by global supply shocks and more by government decisions. When policies change, such as increasing import tariffs or tightening production limits, prices can shift quickly. This can create opportunities but also risks. Higher domestic prices can increase costs for food and beverage companies that use sugar, which might impact their profits. Recent moves by the U.S. Department of Agriculture to block additional imports of specialty sugar show how governments continue to intervene to protect local producers. These policies can also have environmental and social effects, influencing sustainability and regulatory risks in the long run. In short, government policies create a controlled environment in sugar markets. They support domestic producers through price supports, import restrictions, and production limits. For those investing in sugar commodities, understanding these policies is key because they directly influence prices, supply levels, and market risks, often more than global market forces alone.